It is almost noon here in Tokyo. Welcome to Bloomberg Markets Asia. I'm Haidi Stroud-Watts, and here are your top stories. Japanese and Hong Kong shares rising along with US futures. Traders holding on to bets that the Fed will cut this year after Chair Powell's comments about a cooling job market.
This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market.
Deflationary pressures continue to stall China's economic recovery, with consumer prices hovering near zero for a fifth month. Also ahead, Indian Prime Minister Narendra Modi asks Vladimir Putin to seek a peaceful end to Russia's war in Ukraine after a deadly missile strike on a children's hospital in Kyiv. And Temasek is still bullish on India despite high stock valuations after a record run. We get the outlook from the Singapore Fund's CIO. But first, let's check in on how markets are faring as we continue to react to the Fed chair's comments overnight. Avril Hong is in Singapore. Avril.
Absolutely, Heidi. We're seeing that reaction to Powell's comments. He did flag those risks to the labor market, but he didn't let on very much in terms of the timeline of rate cuts. So that goes some way in explaining why we're seeing a bit of a tepid reaction in Asia stocks, a bit of a mixed bag. The Japanese as well as the Chinese stocks are pairing some of the gains from earlier on in the session. These gains you see in the Chinese gauges, worth noting, come despite the CPI numbers coming in lower than expected and showing how the deflationary pressures persist in China. But in terms of currencies, mostly weaker, including on the Japanese yen. Now, traders will also be focusing on the US CPI numbers that come out tomorrow, as will Chair Powell. But in the meantime, let's hear what he had to say in Congress.
I'm today not going to be sending any signals about the timing of any future actions. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be in, as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
He did reiterate the need for more good inflation data, so it looks like mostly sticking to the script here, Heidi.
Avril Hong there in Singapore. But let's take a closer look at how the Fed's next likely move, whenever that may be, might affect high-yield debt. Catherine Braganza is a senior high-yield portfolio manager at Insight Investment, and she's usually based in London, but actually joins us out of Singapore today. Catherine, really great to have you with us. So, first of all, did what you hear from Jay Powell, as nuanced and as careful as he was to sort of stay on message, did it move the dial for you at all?
I think we had seen that unemployment number that he had talked about coming at 4.1 last week. And we saw the reaction in the Treasury curve on that basis. You know, I think the 10-year went back down to 4.4. So I think the market is expecting something in September. And I think all the data that we're seeing, whether it be the ISM, whether it be the labor market, whether it be inflation headlines, and we'll see that soon, looks like a moderating US economy. So we're on track to, hopefully on track to see something from the Fed in September, and the market is expecting something along those lines.
And from here on forward, what do you see as the sort of near and midterm risks for credit?
So specifically, I was going to talk about the high-yield market, and I think the high-yield market is actually strong, and possibly credit markets in general are relatively strong. I think the risks are political. We've seen that around the French election, moderated as the second vote came in. I think that there's still political risks out there. We'll see as we get closer to early November how that pans out. I think also we'll see policy risk as a result of the election risk. And I think we can't keep our eye off the ball of inflation, because it is moderating in the US. It is slowing, I think, in Europe. But as we just heard from the Fed chairman, the labour market is still relatively strong.
You've just listed a lot of the uncertainties there. What would be the strategy to maintain portfolio quality at this point?
Yeah, I think what we've seen is high-yield market participants and us have moved up in credit quality. And actually, the high-yield market is a strong market in terms of the overall positioning and the constituents of the market. I can say that the European high-yield market is average rating of a BB, the US high-yield market average rating of B+, very low CCC component compared to history. And we're seeing the actual underlying businesses in the high-yield market continue to generate cash flow, other than a few specific sectors, continue to generate cash flow and be relatively robust. So in terms of the investment opportunities in high yield, there are many. I think with those outside risks that we cited, inflation risk, or not moderating to the extent that we would want, the election risks that we may see later this year, we think having a short duration bias is the way to go, because you get a level of protection where you're positioned in terms of a curve, but you get a good carry and a good running yield.
Do you expect meaningful changes when it comes to that profile of risk, which at this point looks pretty sanguine?
No, we don't actually, just because companies have done such a great job of getting their houses in order, for want of a better word. We've seen the amount of debt in the overall universe go down. We've seen interest coverage remain strong. Some of the constituents in the high yield market have metrics that are very similar to investment grade. So I think they're positioned well. I think what we saw was COVID was such a shock for everyone, but also the companies in the market, that they quickly came out of COVID and got their balance sheets and cash flow generation in order, and actually are very well positioned for volatility, which we may have, but not originating from the high yield market, originating from outside the high yield market, such as election risk, as I flagged earlier. So no, I think we are quite bullish on the actual high yield opportunities.
Yeah, and it's interesting, one of the sort of suggested strategies is actually a preference for high-quality US corporate versus treasuries, right? Because of the, I guess, perceived risk that maybe with a higher government deficit you might end up with supply issues for USTs. Is that a narrative that you subscribe to?
Yes, but we would move further down the curve. We would say to you that if you can get a yield of 8%, which you can in high yield, and you are confident that there is limited default risk, and we actually think defaults will be very low this year in high yield globally, then take that 8%. That is an opportunity. That is a good, attractive investing opportunity. And if you can position yourself at the shorter end of the duration spectrum, you're protected from a lot of the external volatility that may come from the treasury curve, from election risk, and also from the unknowns that will happen in a slowing European economy. Because at the short end of the curve and short duration assets, you can have greater visibility of cash flow. So yeah, we are bullish, but within that we are nuanced to the shorter end because of the level of the protection you get from being short.
I'm glad you brought up Europe, I should say, in the euro area, because are we getting into a point with the political situation in France where the fiscal position cannot be ignored, as it's been dismissed for so long by investors, right? Do you think that there is a reckoning there for the French bond market that's being set up?
We tend to ignore those fiscal deficits. I mean, the French fiscal situation is not a new factor, nor is the Italian fiscal situation. So we tend to ignore, we tend to ignore those sorts of issues generally. But I think overriding the overriding thought process in Europe will be, what is the macro doing? And Europe faces a difficult time if we get more protectionist policies out of the US. It will impact Europe. It will impact global trade. And I think that will be the overriding narrative rather than the French or the Italian fiscal situation. We will have to think about where growth comes from in Europe.
Catherine, I was going to say, once again, we find ourselves back at dwelling on politics and geopolitics, right? Really great to have you with us there. Still ahead, though, consumer prices in China rising less than expected in June. Deflationary pressures are lingering. We break down those numbers next. This is Bloomberg. Well, China's consumer prices managed only another small gain in June, hovering near zero for a fifth month now. Our China correspondent Min Min Lo joins us now from Hong Kong. And Min Min, although unsurprising, it just adds to the broader picture in terms of the economic weakness here.
That's right. The consumer price inflation data missed expectations by half, coming in at 0.2%. Expectation was 0.4%, and producer price index as well, that had declined for 21 straight months now, coming in at negative 0.8%. In line with expectations, it was falling slower than the previous month of 1.4%, but that was largely driven by favorable base effects. So what this really tells us is that deflationary pressure is still very persistent in the economy, but the problem is growth, though, is looking set to hit the official growth target of 5%. So what this means is that the government is not likely going to feel an urgent need to pull out any big stimulus of the sort that markets are looking for. So that means we're expecting inflation to remain in the doldrums for the rest of the year. Expectation is for annual inflation to stand at 0.6%, which is far, far below that official target of 3%.
And like you say, this data doesn't necessarily change the expectations going into the third plenum, right? Are there policies that could potentially be more pro-growth than what the outlook is now? Because the expectations at the moment are pretty low.
Yes, well, any measures or policy signals from the government will likely not come from the monetary side, because there are constraints around exchange rate stability, which has been a priority of the government, and for good reason as well, because further devaluation of the yuan could lead to further trade tensions, outflow of capital, and perhaps impeding that RMB globalization as well. So any policy boost will likely have to come from the fiscal side. So we expect the third plenum to be focused more on boosting confidence when it comes to household consumption, perhaps signals around income protection, social safety net, and to reduce that precautionary savings that we're seeing among Chinese households now. And for investment side, we're likely to see perhaps signals around better property rights protection for the private sector, for reforms to be implemented, and for market principles to be followed. Have listened to what the Stanchart economist Ding Shuang had told us earlier in our program about what to look out for in the third plenum.
It's kind of a consensus right now. I think the major problem in the economy is low sentiment, a loss of animal spirit. Yeah. So I think the third plenum, first and foremost, provided the government a rare opportunity to tackle the lack of confidence by rekindling the growth-friendly reforms. So we still have to see how effective that would be.
So I think what we want to look out for in the second half is that PPI, whether and when it will turn positive in the second half of the year, because that's been in deflation since October 2022. And that was a year when China was still in the midst of COVID and trying to shake off those COVID curbs. We have seen modest reflation so far, but that's largely driven by commodity prices rather than an improved domestic demand. So that's a big milestone that we want to look out for the second half of the year.
Our China correspondent movement low there, and of course the other big puzzle piece where a lot of this weakness and depression of sentiment has really stemmed from has been the property sector. China Vanke is warning that losses grew substantially in the second quarter, in part from discounts from clearing housing inventory and offloading assets. Our bond and loan reporter Loretta Chen is with us now. So Loretta, what do we know?
So in Vanke's latest Q2 report, it says it's expecting a loss of between 7 to 9 billion yuan. So that's a big jump from the previous quarter, which was already a loss-making quarter. We're seeing these losses, really growing about 300%. Vanke is attributing some of these losses to the fact that it's cutting prices on remaining housing inventory in order to sell them. It's also been prioritizing paying back debt, and in order to do that, it's been disposing a lot of these assets, real estate assets in China at a loss. And analysts are saying that they are not expecting any substantial recovery for Vanke coming into the second half of the year. So these headwinds for Vanke, most importantly, the liquidity pressure will persist for the latter half of the year.
Right, and we are expecting, I guess, ongoing to be that prioritization of cash flow over profitability.
Yeah, that's right. So in the first half of the year, Vanke has said it has prepaid all of its offshore debt. A lot of its onshore debt has also been paid. And in the second half of the year, it's going to prioritize repaying some of these remaining onshore debt. It doesn't have any offshore bond outstanding for the second half of the year. That will continue to be a priority for the company. And right now, what it's doing, apart from selling these assets, trying to list some of its income-generating properties such as malls and rental apartments. It's also trying to use bank financing channels, so pledging more of its real estate assets in order to get bank credit and swapping some of its public debt with these private bank loans. So that will continue to be a priority for the company.
This developer is of course one of China's biggest, and I'm curious to why we've seen, even compared to other major developers across maybe the top 100 in China, we've seen slower growth for Vanke properties compared to the others.
Yeah, that's right. So Vanke has most of its property projects in the first-tier cities in China. And you're seeing over the past couple months, there's been policy rolled out to lose house purchasing restrictions on these first-tier cities, including Beijing. But these policies have very, very limited impact. And in the first-tier cities, it's also where higher-income people, the middle class, are hit the most by China's slowing down economy. You're seeing a loss of confidence, and I think that's why part of the reason that Vanke is hitting hard by that confidence crisis that's ongoing in China's property sector. There's also factors such as the company actually has not been acquire more land in order to continue its business operations, and I think that's already showing up in its annual results.
Bloomberg's bond and loan reporter Loretta Chen there with the latest. Plenty more ahead. This is Bloomberg. Samsung shares are actually a little changed, interestingly, even after the company's biggest union declared an indefinite strike. The call sharply escalates the dispute with the Korean conglomerate. Let's get over to our tech reporter, Annabelle Jewellers, who joins us in Hong Kong with the details. And, well, it's interesting, the lack of reaction we see when it comes to the investor reaction, because this is a pretty bold move in terms of the timing.
Yeah, absolutely. And we can get more on that in just a moment, why this is so significant now and the impact it could have on production, rather. But just to get you up to speed with the latest here, as you said, Samsung's largest union, so it counts nearly 30,000 members amongst it, has now ordered a general strike that could go on indefinitely. So there has been labour action at Samsung. It's the first time we've actually ever seen it in the company's 55-year history. This is, of course, the most grave now, but it actually kicked off earlier last month, and so we saw a one-day strike then. This was supposed to be a three-day strike, so Monday, Tuesday, Wednesday of this week, but just early this morning, the union came out with a statement saying management has not been prepared to engage engage with us here, and that's why we're ordering this indefinite strike to take place.
And obviously the point of this is to try to throttle production, right? Does it meaningfully disrupt things on that front?
Yeah, to be seen really on that front. But even on Monday of this week, Samsung's union was saying that it would disrupt production, and Samsung was hitting back saying no, it wouldn't have any sort of impact. It's clearly something that's being tracked really closely, because a lot of these union members and the ones that went on strike, you can see here in these images on Monday, but these members are actually from that critical chips division, and it's a very important point for Samsung right now, given that there's this huge race around AI chips, and we are seeing Samsung, for instance, falling behind SK Hynix and HBM in particular. That's high bandwidth memory chips that are critical. Samsung's also trying to get key customers to sign on, the likes of NVIDIA, for instance, and so a very important timing, especially when you're starting to see those green shoots in other parts of the chip space as well, and Samsung, for instance, being able to also command greater prices for its products.
What would be a win for the union? What do they want?
There's a couple of different demands. They're looking for compensation, of course, from these strikes. But really the main one, not only they want some higher pay, but it relates very critically to bonus payments. So one of the gripes that the union has is that this is calculated using quite a complex process. They don't just take operating profit, they make some deductions, they adjust it on a cash basis. And Samsung's really out of lockstep with global peers here in the tech space. So that's really what it relates to. They're also looking for workers to be perhaps given a greater bonus as well, because last year, again, that critical chips division, it was loss-making, so workers didn't get any bonus payment. But bonuses are really important to the take-home pay packet for Samsung employees, given they do make up quite a large proportion of it. So that's really the key demand here. Greater transparency around how bonuses are calculated, and also compensation.
And of course, in terms of the timing, they were probably hoping, Samsung would be hoping that all of the focus would be on its new gadget lineup in Paris. Not so this week.
Yeah, that's right. I mean, it's not great timing at all. And perhaps, of course, it could have been coincided with it intentionally to get that limelight away. But that Samsung Galaxy Unpacked event is coming up on Wednesday. It's actually being hosted in Paris this year. These are typically held in international locations. Only last year was the first time I think it had been held in Seoul. But essentially, what this is we're going to get this new lineup of the focus really on the Galaxy phones and the watch models as well. So far, what we're understanding, one of the highlights could be is, again, that Galaxy Watch model. It could be something that gives you more indications of your metabolic health, your biological age, and this is also trying to advance Samsung's lead here in this space over its peer, Apple. So something we'll be watching again, but the focus very much on what's happening back in Seoul, and as we said, this indefinite strike that is now being ordered by Samsung's biggest union that counts nearly 30,000 members.
Annabelle Jeweller's area in Hong Kong with the latest on Samsung as we continue to watch those developments. Taking a look at some of the movers that we're watching in the China session. Of course, the inflation numbers certainly continuing to disappoint and painting that picture of broader economic sluggishness. But when it comes to some of these automakers, we're seeing some pretty broad positivity there across that sector. Beidou, for example, surging in Hong Kong. We're seeing robo-taxi orders increase for that company with a growing popularity over the Apollo Go in China. We're also seeing BYD rising just short of about 1.7%, as much as 1.9% earlier. JP Morgan boosting that price target there. Also watching Kiwi assets as we see that rapid, painful reversal of that crowded long Kiwi dollar trade. This is Bloomberg. All right, let's get a quick look at China markets as I head towards the lunch break. We'll get over to Avril in Singapore. Avril.
Yeah, Heidi, we're seeing two main drivers of sentiment in the markets today. The CPI number out of China, lower than expected, showing how deflationary pressures persist, but also China Vanke warning of those deeper losses in the first half to show you the housing slump in the country. Amid all this, it really highlights the need for stimulus, but observers don't see very much in the way of that coming on the third plenum. Of course, that's next week. So the focus shifts to the PBOC, and in the wake of the CPI print, the team at Bloomberg Intelligence expects the PBOC to cut its one-year rate in September. Why September? That's because that's when the Fed is also expected to cut. So against that backdrop, we're seeing the CSI 300 enter the lunch break with not that much gains. It's just a flat line there. Hang Seng also erasing much of the gains from earlier in the session. The onshore yuan is weaker. We're seeing that bond rally in China picking up again. Let's flip the board because that is a bond rally that Chinese authorities have really been taking pains to cool, whether it's through verbal warnings or, piling up inventory of bonds to sell. And based on the recent survey by Bloomberg of traders and analysts, traders see two lines on the 10-year yield, that is at 2.25%, on the 30-year yield at 2.45%. Those are the levels to watch for when potentially they expect the PBOC to kind of step in. Of course, this rally in bonds is driven by the economic weakness and the expectations of easing from the PBOC. Heidi.
Hey, everyone there in Singapore. And Singapore's state-owned investment fund Temasek has revealed its investments in China are now below those in the Americas. This is the first time in a decade. Temasek reported a modest full-year return of 1.6% as China's market slump offset better returns from the US and India. CIO Rohit Sipahimalani told us more about their outlook.
So the challenge in China is one of confidence, consumer confidence, corporate confidence, investor confidence. And of that, I think the most important is consumer confidence, which is being dampened both by what's happening in real estate and the fact that there hasn't been that much demand-side stimulus to sort of help propagate that. Now, the government's clearly very focused on economic development. You hear that every day. So far, we feel that the measures have been more on the supply side and need to be probably a little more on the demand side and address the decline in real estate. And the reason for that sentiment is very important on the consumer side, because apart from just GDP and real demand, I think that's going to be the key catalyst for the stock market. I don't think you can really rely on a sustainable basis now, a lot of US endowments or pension funds coming into the market. But there's a huge domestic savings in China. Today, historically, they went into real estate. It went into trust products. Neither of them are really viable alternatives right now. You would expect that at these valuations, they would expect to put money in the stock market rather than earn 2% in the bank. But today, they're still earning 2% in the bank. But if you can get that sentiment to change, there's a lot of that money that can flow into the stock market. And I think that will be the catalyst. Now, I don't know whether it takes 3 months, 6 months. It'll depend on what happens. But we've seen in India that once domestic flows come into the stock market, it actually acts as a huge counterforce to global forces, adds a lot of stability to the market, and will be a catalyst. In the very near term, I think you need to see it. We saw people getting excited in April in China. In between April and middle of May, MSCI China was up 16, 17%, best performing market in the world. And then again, people felt disappointed with the extent of measures taken on real estate, and we've seen a slump back. But second quarter as a whole, China performed better than the S&P 500. So there will be periods, I think people are looking for signals to see that what will sort of catalyze that return of confidence. And I think that will be the catalyst, but I can't tell you the timing for that.
Might the third plenum be a catalyst? Could that be a game changer?
So expectations are low from investors because they're saying, we need to see action. And so it could be a catalyst just because expectations are low. So if they actually surprise positively, I think that could be a near-term catalyst.
You talked about how domestic and retail investors can cause a turnaround, a reversal in China's stock market. But other people say that perhaps Chinese equities will continue to hum along at such a pace until foreign money comes into China. That's unlikely to happen as long as you get those returns, for example, in the US.
So I think it's, like I said, people in in April came in because they thought valuations were really cheap, saw some signs of action to the real estate front, which got them excited, and you had this huge rally, and then they were disappointed. I think foreign money in the near term can lead to short-term spikes. But for sustainable returns in China, I think you need domestic money, because there will be large sections of Western money which will always feel pressure. I can only see US-China tensions go up, not go down from here. So which is why in the long run, I think it's going to be For sustainable returns, you need domestic money. We've seen that in India, where India now that systematic investment plans get in $3 billion every month into the market. In the past when there was a crisis overseas and money moved out of emerging markets, the Indian market would correct 20, 30%. Now it barely moves because domestic money fills the gap. So I do think ultimately for sustainable returns, you need domestic money to come back and confidence to come back. Short term, yes, blips could happen through inflow of foreign money because of sentiment changing.
We've seen how some financial institutions have made a complete exit from China. You're still there. Why are you a believer in the Chinese market, and how are you invested in China right now?
So look, it's the second largest economy in the world. I would say today, more than anything else, it's actually a good diversifier from the Western world also. The two markets don't move in tandem, and the first half of the second quarter was a good example of that. But clearly, we have to be concerned about businesses that are caught in the crosshair of geopolitics. We've got to be conscious about investing in sectors that are policy aligned. And so effectively, our focus is very domestic. So domestic consumer brands, for example, whether it's around cosmetics, whether it's around beverages, whether it's consumer durables. I mean, all these, if I was in China 2 weeks back and talking to a lot of people, yes, overall consumption is slow, but people are very value for money conscious, which is helping domestic brands over some of the higher priced foreign brands. So that's one segment. Import substitution. There's a whole supply chain around, let's say, electric vehicles, robotics, other industrials, competing with multinationals like Bosch, Siemens, ABB. And that's one trend that's only, these companies are getting stronger, and they're only going to be encouraged in the market out there. So that's, again, a trend that is very positive. Biotech, you're seeing innovation out there. The number of out-licensing deals from China has gone up 3x in the last 3 years. And this year itself, $4 billion plus acquisitions have been made by MNCs of Chinese biotech companies. So people see that happening. So there are these areas which, are not going to be caught in the crosshair of domestic regulation or policy. They're not in the crosshairs of US-China tensions. And you're seeing steady growth.
Why is India still attractive given the high valuations you're seeing right there? Some are already predicting that perhaps, their earnings might not be able to keep up with valuations.
So there could be short-term pullbacks, like I said, in any market. But even today, even when India is trading at, the Nifty is trading at 22 times earnings, over 1.5 to 2 standard deviations over historical averages, you still have a situation where certain sectors, for example, financial services, which we have a significant amount deployed in, not just banks, but insurance companies, asset management companies, etc., those are still trading at fairly reasonable multiples compared to history. So I think then on the private side, the specific opportunities, we invested in Manipal last year, which we were a minority investor in for 5 years, so we knew it well. And we felt there was an opportunity to sort of take a much more substantial stake at values that we thought would give us really good returns given the tailwinds behind that sector. So there are bottom-up opportunities in India. Structurally, we see it on a strong growth path. We see a lot of spend on infrastructure around digitization. The startup ecosystem is very, very strong. And now you're having new companies emerge from people who were in the earlier unicorns. So overall, I think it's a pretty attractive market for us.
That was a Temasek CIO Rohit Sibahimalani there speaking with our colleague Haslinda Amin. Staying with India, and foreign investors are flocking back to the country's stock market, helping to propel benchmarks to fresh highs. Let's bring our Asia equities reporter Ashutosh Joshi. So, Ashutosh, it seems like this shift back is coming pretty quickly after the narrow election win. These risks have just dissipated?
Yeah, hi. Foreign flows to India have been a sort of volatile in the last 2 years. However, on a longer basis, they remain buyers of Indian shares. The latest bout of buying has come obviously following the election outcome in India, wherein the new government under Prime Minister Modi has assured its reforms agenda. The Modi-led party also showed its ability to forge allies and made its claim to the for third successive term as India's Prime Minister, and this has in a way boosted confidence among global as well as local investors. If we see prior to the elections, the foreigners were sellers of Indian shares, but this strategy has clearly changed upon elections. We have seen since start of June more than 4.5 billion worth of foreign flows coming under the FII or FPI category, which is more than the selling these investors made in preceding 2 months.
As you mentioned, there are domestic flows as well as foreigners returning, right? So does that mean this is sustainable? Will we see inflows continue?
Yes, domestic investors have been key drivers of Indian equities rally. If we see so far this year, India has received $28 billion worth of domestic inflows, while that compares with barely 1 billion from foreign investors. This liquidity is crucial for Indian markets to sustain their rally. We have seen that valuations in India have typically traded at a premium to Asia as well as emerging markets. This has so far held because there is supply of domestic money. Foreign flows have been volatile. Foreigners have regularly taken out funds from India, but at the same time, with mutual funds getting more than 3 billion worth of domestic money every month, that is keeping this rally hold up. Now, next event to watch will be the budget and earnings season.
Yeah, what are investors expecting from those events?
Yes, earnings will be more crucial than the budget. This is a follow-up for the past provisions and will be a vote on account. Still, there are some expectations about some changes to the tax brackets, which would allow, this would be mainly aimed at boosting consumption in India, which is an area for the government. On the earnings side, however, there is a mixed sentiment. Some analysts are expecting earnings season to be not as great as in the past, and there could be some disappointment here. This could impact a sentiment towards Indian stocks, at least in the shorter run.
Are we seeing the excitement, particularly across the retail investor, when it comes to IPOs, also adding to the rejuvenation of this rally?
Yeah, IPO is a sort of extension of rally in India. We have seen some of IPOs getting more than 200 times the portion allotted to retail investors. So there is massive demand. This is a sort of frenzy we are seeing among retail investors. This is clearly driven by Indian stocks' ability or IPO's ability to generate more returns on listing day. We have seen the kind of premiums or the gains made by Indian shares upon their listing are significantly higher than compared in Asia or globally. So for some investors, this is a quick money, and this is a sort of driving demand for IPOs from retail investors.
Our Asia Equities reporter Ashutosh Joshi there, and of course we're just minutes away from the start of trading. Take a look at how pre-markets in India are looking ahead of that market open, as we've just been talking about the return of both foreign as well as domestic inflows, really setting up Indian stocks for another positive day. We have hit record highs, but Nifty 50 futures for July rising, seeing perhaps a slightly muted start to the session, but we do have a couple of debuts after their IPOs, including MQ Pharmaceuticals, Bansal Wire Industries as well, and Tata Elxsi is scheduled to report earnings today, as well as a number of annual shareholders meeting are on tap today. Well, coming up, Indian Prime Minister Narendra Modi urging Vladimir Putin to seek a negotiated peace in Ukraine, with the latest on this diplomatic mission next. This is Bloomberg. All right, let's get you straight to the start of trading in the Indian market. And of course, we have had a number of pretty hefty gains recently, largely with foreigners returning to this market. We're seeing new all-time highs for equity gauges in India. And in fact, when it comes to foreign buying on a net basis, topping $4 billion since the start of June. So really much more than being able to make up for what we saw in April and May with those outflows. It is a little bit of a tepid start to trading. The Sensex is softer by about 1/10 of 1% there. We're seeing the Nifty index off by just about 1/10 of 1% there as well. But some of that sort of risk concerns about policy continuity after a kind of a lackluster showing for the Modi-led party on that June 4th election, some of that has certainly faded, and we're seeing that return of certainly interest there. Well, Indian Prime Minister Narendra Modi has used his Moscow visit to urge Russian President Vladimir Putin to seek a peaceful end to the war in Ukraine.
India is ready to provide support for the restoration of peace. I was very happy to listen to our opinions on it. I assure you and the global community that India favors peace. After listening to my friend President Putin, I am hopeful for peace.
For more, let's bring our government reporter Sudhi Ranjan Sen. And Sudhi, it's interesting, these remarks, right, given that the Indian leader has largely tried to tread quite a fine line in terms of commenting on this conflict. So how are these comments on Ukraine, particularly following the attack on the Children's Hospital, being interpreted?
Well, I mean, we've seen, reactions from across the world, and they've not been very, very favorable. We've seen the State Department, although a very cautious and a very guarded remark that has come from the State Department as Prime Minister Modi landed in Russia. We've seen remarks from Ukraine coming, and the sense that we get by speaking to people on the ground here in New Delhi is that India is very, very aware of this and is trying to kind of get over this. And its stand, so to say, on the Ukraine war hasn't quite changed, although we have seen a different wording, a different formulation coming from the Prime Minister saying that you cannot find peace in the war, in the battlefield. But beyond that, we haven't seen Prime Minister Modi or India going, saying anything different from that. You need to sit down and you will find peace only through diplomacy and dialogue. And that's what has been India's stand. So if one were to look at it from the Western perspective, the US perspective, which has been trying to isolate Putin and punish him for his war in Ukraine, not much change that we can see in New Delhi. It's basically the same stand that New Delhi maintains.
And of course, going into this visit, the role of China was always going to loom large, right? So have we seen that sort of been sidestepped? What are the main takeaways or any deliverables from these meetings?
Well, there are a couple of deliverables from the meeting. Sorry, and one of the things that we see is that in the area of military hardware. In the briefing yesterday, India's Foreign Secretary kind of said that India and Russia are looking at long-term production of spares. Now, India's military is very, very dependent or heavily dependent on Russian hardware, and that becomes even more important because of the border dispute that is on with China. It started in 2020. Both sides have kind of mobilized thousands of troops towards the border. India's military needs a lot of spares. And one of the things that has come out and was kind of declared or made public yesterday is that India and Russia are now talking about jointly producing spares in India. That's one big factor. The other factor is India is also looking at long-term contracts, energy contracts with Russia. There is also, there was a clear indication from the briefing yesterday that India and Russia are getting into a long-term uranium supply agreement or pact for the civil nuclear reactors that India runs. So there have been a couple of deliverables, but at the same point of time, nothing out of the ordinary, nothing that was not expected.
Our government reporter Sudhi Ranjan Sen there with the latest on that Modi-Putin meeting. And staying with geopolitics, the NATO summit has begun in Washington with a pledge to further boost Ukraine's air defences. Bloomberg's Kaylee Lyons has the latest.
The first of a three-day NATO summit here in Washington kicked off on Tuesday with remarks from President Joe Biden, of course, marking the alliance's 75th anniversary and also coming at a high-stakes moment for the president as he faces questions around his mental acuity and fitness for office and whether or not he should be the Democratic nominee for president in this 2024 election cycle. President Biden, in his remarks, talked about the importance of NATO in countering what he described as autocrats looking to overturn the global order, and also focused heavily on Ukraine amid its ongoing war with Russia. He said that Ukraine can and will stop Putin. He also announced that the U.S., together with other allies, will be providing 5 long-range air defense systems to help Ukraine, in addition to sending dozens of shorter-range systems. Now, the president did end his remarks somewhat unusually, choosing to bestow the Presidential Medal of Freedom on Jens Stoltenberg, NATO's Secretary General. It is the highest civilian honor the U.S. has to offer. In Washington, I'm Kaylee Lyons.
Plenty more ahead. This is Bloomberg. Well, one of the big stories moving markets today is really even that weaker than expected China inflation picture, that deflationary element remaining a key threat to the economy just days before that crucial plenum meeting of policymakers and top leaders kicks off at the start of next week. Of course, expectations going into these meetings are very low when it comes to any kind of meaningful big bang boost to the economy and therefore to broader markets as well. And there is a sense that investors are certainly losing their patience for further stimulus measures. That cooling in the CPI is a symptom, according to Bloomberg Economics and other economists, of weakening consumer demand, probably even weaker than what had earlier been expected. And all the more perhaps a little bit more shocking given that we still had that favourable year earlier, I should say, comparison base as well. And still that came in weaker than expected. Factory gate prices also extending that deflationary run to now 21 months as well. Elsewhere, we're watching still that reaction across the RBNZ. We were speaking earlier about just how crowded this long Kiwi positioning had been. That trade was the most crowded since December 2021. We're seeing that painful unwinding now with that more dovish than expected sentiment coming from the RBNZ, even with that hold. They really were looking, traders that is, in that positioning for the vigilance from Governor Orr, and that was a softer take than expected and really compounds the concerns about how much the economy has been slowing there as well. Taking a quick look at treasuries, of course, we're still sort of processing through some of the nuanced comments from Chair Powell in the first day of his testimony to Congress, flagging those rising risks to the jobs market. And that was really the key element there, the shift when it comes to messaging on the labour market. And these rate cut bets are still being held for the rest of the year. That is it for Bloomberg Markets Asia. Horizons Middle East and Africa is next.